Gold in focus losing its luster, hitting its lowest level since June as higher rates and the US dollar sour the environment. For more, joining us now is Tim Evans from Longleaf Trading Group from the CME in Chicago. Tim, good afternoon to you. Really interesting to see gold. We saw reports yesterday hitting a 5.5-month low. We're also seeing domestically anyway, gold miners also really struggling on the share market. What are you making of this?
Yeah, hi Natalie, nice to be with you today. I mean, I'd have to say probably the group that was more disappointed, following the results of the Trump election, other than Hillary Clinton, her supporters, were holders of gold. The way the market has received, the election in terms of the impact that investors think it'll have on the market clearly has not benefited gold. So yeah, I mean, we've obviously come under significant pressure from the highs we had the night of the election to where we are now, which is basically back to the June lows.
This really goes against everything, however, that we know again about gold in terms of investors flocking to it as a safe haven asset. There was no more, not a more uncertain event than this election, and the results certainly went against all market expectations. But are we seeing greater risk appetite then coming through from investors, and is that why they're turning away from gold as a safe haven asset?
Yeah, I mean, gold, the environment that we're kind of finding ourselves in here this week and that we had, the second half of last week is one where all the elements that have, people interested in buying gold are now gone. We have an environment, obviously, that we've had for a long time now, which is a low interest rate environment. Clearly the market is pricing in the potential that we could be seeing substantially higher rates in the near, intermediate, and long term. The cost of holding gold is higher with higher interest rates that we've seen here over the last week. So, it makes it perform worse as an investment. And also the safe haven bid that you typically will see when markets come under turmoil are not there either. Interestingly, the only moves higher we've had in gold is, in those periods where a lot of doubt came into the market. And, right now, for good or bad, the market's pricing in a lot of optimism. And yeah, gold ain't going to do very well when that's taking place.
Well, it's not just gold. We're also looking at silver. Sort of the madness in metals is spreading, as it were. Silver's set for a 10% two-day tumble. Now, we've got a chart up on screen. Tim, I appreciate that you can't see this. However, for our viewers at home, the white line that you see there is the silver price. Now, the pink at the bottom is the rate of change, and the metal's down about 10% in just 2 days. So how is this acting then, Tim, those moves in gold as a ripple effect across sort of other commodities within that metal space?
Well, at the end of the day, the US dollar is really what's controlling the whole space. Metals internationally are dollar denominated, and that doesn't matter if it's gold in America or gold in Australia or anywhere else around the world. An international transaction takes place in dollars. So all else being equal, when the value of the dollar goes up, the price of whatever commodity you're pricing in dollars goes down. Gold obviously is very sensitive to the inflationary effects of the market. So all that being considered, gold, silver, or any of the base metals typically will not perform well when the dollar's higher. Obviously, copper, is kind of the outlier in that group, but, there's some supply side issues that are contributing to that.
We had earlier in the show, Donald Trump was referred to as President Inflation, and that really seems to be coming into this idea of anticipation of growth, anticipation of inflation, but also we're seeing that higher US dollar. Is that going to exacerbate this idea that we are likely to see inflation within the US economy in that short-term period?
Yeah, the dollar is this. I guess you can kind of call it a pro-America rally. The world and the global investment community is kind of looking at America as potentially the place to be here in the near and intermediate term with respect to investments. If you kind of consider your kind of classic definition of GDP equals C plus I plus G, which is consumer spending, investment spending, and government spending. The rhetoric coming out of the the Trump administration, or soon-to-be Trump administration, is one where we're potentially going to see improvements in all three of those variables. You know, with tax reform coming potentially down the pike, that obviously has a chance to dramatically stimulate consumption. Tax reform, corporate tax reform, clearly has the potential to stimulate investments. And this dramatic infrastructure program that the Trump group so far is talking about implementing upon taking office will dramatically increase government spending. So, I mean, it's a recipe and a formula for GDP, economic growth, and, you know, considering the fact that investors chase yield, the U.S. dollar is the primary benefactor of all of this.
If we consider then that we are in perhaps this new era of inflation, this is a negative for bonds, and we're seeing sort of that global bond rout underway. Again, how longer term is that expected to kind of continue?
Well, you know, if you look at kind of the trend that we've seen in Treasury markets, I mean, really going back for 30 years, you know, we've been in a cyclical downtrend with Treasuries. There's a variety of different reasons, which probably is outside the scope of this particular conversation, but given the changes that are potentially going to be occurring, you know, this downward movement we've seen in bond yields for a long period of time has the potential to be reversed. So if you kind of think about it, you know, maybe like a rubber band, you get that rubber band effect where they can snap back very aggressively and they can carry a long way. You know, I think achieving 4% on the 30-year bond is not out of the question in the next couple of months. You know, if in fact the rhetoric coming out of the Trump administration, as we're currently hearing it, continues and the market continues to receive it that way.
Well, for viewers at the moment on screen, we do have a chart showing the idea of that Trump thump and the routes that we're seeing in global bonds and emerging markets intensifying really as the dollar's rise continues. Tim, we'll have to leave it there. Thanks so much for your time today.
Thanks, Natalie. Have a good day.